another Rose Cup webinar, number 8, Make It or Break It for the affluent customers. We have some long-standing supporters here. Welcome back. And for those who are here the first time, we try to run Rose Cup webinar series on a regular basis, and covering a wide range of topics that has a big impact on your personal finance and long-term financial planning, such as immigration, tax optimization, and funding your children's private education, for example. All our webinars are recorded, so if you would like to watch the previous recordings, please go to our YouTube channel, and they will be available on our new website in a few days or so. So the typical format is an hour. We would have a conversation for about 45 minutes or so, and then have the Q&A towards the end. But please do ask questions along the way, so we can have, have it ready to go by the end. Here with me today as our special guest speaker is Nick Middleton. So Nick used to work for UBS, whereas myself work for Credit Suisse, the two big Swiss rivals, but we get along with each other because Nick is another rare former wealth manager who shares the views that we could use technology so much more to make our service easier to understand and to access. And Nick has done, much more than just wealth management, as he has been a strategic advisor to many other businesses in our industry, and most important, started something actually similar to Rose Cup called UBS SmartWealth during his years at UBS. So let's welcome Nick.
Good afternoon. Thank you for having me.
Thank you for joining us. And today, we're talking about the affluent clients, make it or break it, and given your decades of experience of working with them, Nick, what are the things that you come to mind? So maybe we can cover the key topics here. So maybe we can start with the overall landscape of what you have observed through those years, and then we can talk about the practical to-dos and not to-dos for the audience here.
Okay, yeah, that'd be an absolute pleasure. And I think that, as you mentioned in your intro, there is a role that I think technology can really play in wealth management that not a lot of firms, established firms, are really making the most of. And that's given rise to a huge opportunity in the market for new entrants such as Rosecut to come in and to provide a service which is not available really amongst other private banks and traditional wealth managers. I think, as we've both discussed many times, Xiaojia, the private banks and existing wealth managers are all sort of pushing up into ultra high net worth and high net worth brackets. And that means that there's a lot of people out there who could do with some assistance around their finances and making investments that, they haven't really got access to those tools. And that's why technology has really come into play. We've seen a number of entrants in the market, Nutmeg being the first back in 2011, and a slew of digital businesses out there. But I think, one of the main problems is that with so many new entrants into the market, not all of them are equal. And not all of them treat customers in the same way. And whilst you might think you're getting advice or guidance, in actual fact, at the end of the day, the way a lot of these platforms are set up means that you're not getting something that you can really hang your hat on and build a proper portfolio from. So I think, along with whilst there is a lot of choice, there's also a bit of danger actually. And as I said, the second point means that actually, because there are so many new entrants, the price point has been falling. It used to be that you wouldn't be able to get investment management services for much less than sort of 1.5 or 2% all in. But now you could go to someone like a Vanguard or a BlackRock and get something for very cheaply. A Vanguard Life Strategy Fund, you can pick up for 23 basis points. Now, whether or not that is the right investment for you to have is not really covered. You sort of go in and tick add to basket, and then you're invested. So although it might be cheap, it might not be the right type of investment for you.
Yeah, I would say that's so true. Nick, we had a client who made some proceeds, and maybe it's too early to talk about performance, but he decided to try Rosecut versus Vanguard and split the money equally into 2 pots, and came back reporting that since the time he invested sometime last year, Rosecut has been flat and Vanguard has lost him 6%. And on the same risk level and the same entry time, right? So then you would notice what the difference is only after you commit. And I think your point about the different types of services in the market through this whole technology is very different, right? So there are trading tools, and there are guidance tools, and there are advice tools, and this is something people are not familiar with, or sometimes confused with. And when you have a trading tool, you're very much encouraged by the design of the user face to trade, whether that's good for you or not. We have talked about a lot in the past. Whereas you have a guidance to go into a specific products, or just a general direction of where you should allocate your money. That's very different from when you have advice to someone properly looking after your money. So what would be your suggestions on what people should look out for?
That's very interesting, actually. An interesting question. The sort of the final point here is, where do you go to get advice on that? With almost everything else, there are price comparison sites out there, right? For your broadband, for your life insurance, for car financing, you name it, you can find comparison sites that set out the difference between everything. That doesn't exist for investment. And as you said, there are trading platforms, there are guidance platforms, there are advice platforms, but they all sort of come under the same bracket, which makes it very confusing as to where you go. I think that there are some solutions out there that do provide people with a bit of guidance around, and I think really that's kind of where you should be starting out, trying to find someone who will take some responsibility for your investments, and not just an algorithm. I think is probably quite key.
That's a good starting point. Yes.
You started to make some money. Now, what do you do with it? This is, I think, one of the biggest failings that we face as a society. Financial education is just not on anyone's curriculum. It doesn't form part of what you're taught at school. There's no support around university, and yet people are encouraged to go to university and take out huge amounts of debt. That might not be right for everybody. And when you start work, it's sort of there's the coffee machine, there's the filing cabinet. No one says, and now you should start making the most of your tax-free allowances and investing some of your excess money. Those conversations just don't happen. And I think people find themselves sort of almost sleepwalking into problems. They might be feeling as though they're doing the right thing and saving some money, and then as they go through their career, they become much more senior, they earn a bit more money, the structure of their remuneration might change as well. They might end up with stock in the same company that they're working for, which is in the same industry. I'm thinking of lots of people who had pensions wiped out from the banking crisis because they hadn't realized really where all their wealth sat. So I think it gets to a point almost as you go through your career, it becomes a bit embarrassing for people to go and ask, what is an ISA, what is a SIP, what do I do with my money? So actually, I think there's a real opportunity for some of the digital platforms to provide education as part of their offering, so that people can be helped in making the right decision, because it's really tricky. and as an industry, we're terrible. We're absolutely awful. We make so many things so confusing. I'm afraid, having been through this presentation, there's some prime examples later on. We've got ISAs and JISAs and LISAs and SISs and SASs and SIPs and all kinds of things. We love an abbreviation, and it makes it very hard for people to really navigate what their options are. And back to which platform do you select? Who do you go to for your advice? Lots of people talk to friends and family, but what is right for one family member might not be right for another family member. One of your mates may have made a whole load of money trading NFTs, but in actual fact, is that where you want to be? Is that the right level of risk for you? So you really need to find someone who can help you and hold your hand.
Yeah, I totally agree. I think, a few observations I have is that people do talk to their friends and family circles and tend to copy what each other are doing without, acknowledging there's a bit of a difference in terms of what they want. It's not like, it's the same thing like if you have some health concerns, you go to see a doctor rather than copy your friend's prescription, right? You need it to be bespoke to your personal circumstances. And strangely, many people have the sense of they could just hack it or DIY this kind of things without acknowledging financial investing, and all that knowledge takes years of training and practice to get right. And maybe because of the fact that you talked about the lack of financial education at school and things like that, people felt like this is something where they can't really ask, even these are super intelligent, career-driven people. So especially with the jargons they are facing. So this becomes a very high anxious topic when people talk about it. During our customer insight sessions, when we ask very straightforward questions to say, what do you do with your spare money and things like that, the answer was not typically, oh, what I do with it, but oh, I know I should be doing more. I'm so bad, I'm not doing enough of it. You quickly see the anxiety and shame on people's face, which does not have to be the case. I think what we will next talk about is to show people what the typical journey is, what everyone goes through, and how you can get better at that. But the final point I would make is that retirement is not handed out; it needs to be earned. What I mean by that is that people usually have this a sense of, okay, let's look at this later on. Things will sort it out by itself. By the time they get to their 50s and thinking, I want to retire in a couple of years' time. And if you talk to a financial advisor by that time, it's too late, because typically you haven't earned your retirement and it's highly unlikely you can just rely on the state pension. I looked into my state pension the other day, and by the way, it's the same for everyone. It's about £180 per week if you pay 30 years straight in a line, right? That's not going to cover the living expense of living in London. When you think about it, the UK pension system, by the way, is another weird animal, where most other countries would have an investment fund, contribution goes in, the money creates return and pay everyone else, whereas a UK pension system is a conduit. The money we pay through our national insurance into it gets distributed straight away from the other side. There is no, incremental return on that. So how little can we rely on that is yet to be seen by the time we retire. So these are all the things that, actually comes down to individual level to figure out ideally earlier in the stage of their life.
Yeah, I think that leads us probably quite neatly onto this bit. Confusing wrappers with an investment decision. I had someone we met when we were building UBS SmartWealth. He was a very senior private client lawyer, and at the time he was quite excited. He had lots of clients who were also clients of UBS. And when I told him what we were doing, he said, "Oh my gosh, you mean I can become a client of you guys?" And I said, "Yeah, absolutely." I said, "Well, it depends how much money you've got." Bearing in mind our initial amount was only £15,000, I felt pretty sure he could become a client. It turns out that he had pretty much everything he'd ever earned in cash. He said, "Well, I've done my SIP and my ISA." I said, "Okay, what's it invested in?" "Oh, it's just held in cash." And this is a senior partner at a prestigious law firm, who really should have known a bit better. But again, I think he sort of walked into it, and thought I think a small degree he thought he'd done the right thing. We got to the bit where he had all his money in cash, right? Yeah, so I think he'd made the right decision as to where to put the money, but had never made that next step and actually decided how to invest that money. And this was someone who was completely surrounded all the time by investment professionals. So if he finds himself in that position, what help the rest of us?
Yeah, it's tough to figure out these differences, and we often see people mixing up their asset allocation, thinking the pension and ISA are two separate things. But if you hold equities in them, and they should be counted as one allocation in your overall assets. And the second point you have here, holding your nerve, timing the market is often the topic in the recent times. What do you want to say about that?
Well, I mean, yeah, it's a big step, and this is one of the problems, right? Moving from cash, which we all think we understand, into something which not everybody understands, and is awash with jargon and is complicated. Markets are volatile. It's entirely feasible that you could put some money in, and the next day you'll see markets fall. Now, a lot of people could get scared at that point and start taking their money out. Well, really, you actually need to stick with it. We used to always recommend that people broke their sort of target investment pot up into fractions, be it into 4 or into 3, and either invest it once a quarter or over a regular period of time, so that you don't overcommit at one point in the market. And you don't then find yourself in a position where you have invested and markets have gone down. But equally, if you look back over time, yes, if you look at those periods of extreme market volatility, be it the Great Financial Crisis or even the crash in 1987 and these sorts of things, it didn't take a huge amount of time for markets to recover. It was painful along the way, but if you think about it, if you started investing in February 2008, the bottom of the market wasn't really until sort of February 2009, and it didn't really recover, funnily enough, until about a year later, February 2010. But if you were pacing and dripping your money in during that period when markets were falling, you would have been back broken even in mid 2009. That's not a huge time really if you're thinking about it, a 20-year or 25-year time horizon. So you really do need to stick with it. And I think this is where wealth managers have a real responsibility. We have a responsibility to our customers to make sure they're getting the right advice, and to explain to them they don't need to worry about a little bit of short-term volatility.
I totally agree. I think I would just add that people almost feel that they can strategize and getting at the right time, and waiting until the market is down if they understand already the volatility of the up and downs. But it's very easy to judge looking back afterwards wisdom to say, oh, I should have got in there. But if you're looking ahead, that's always a difficult decision, and there's enough numbers in the financial history to prove that the best course of action is stay invested until the moment you actually need the cash. But stay invested in what is another topic we will cover later on. Because if you are such a firm believer in, let's say, Tesla or some single companies, and put all your money into that, you are literally hanging your future on a single company that has exposure to a lot of risk, and that's not wise either.
No, absolutely, yeah. And I think the other issue which we come across as a problem for people is knowing when to sell. Both in a positive way and a negative way. I once had a mentor in my first company who one of his sort of stock phrases was "No one ever went bust taking a profit." So it does make sense if you've made some money in a particular stock or a particular strategy to take a little bit off the table. You don't have to sell all of it, but it's probably sensible to reduce your exposure. Sorry, I didn't mean to do that, to a particular asset. But equally, we all know people who've had holdings that they thought they were buying for a very short-term reason. They end up holding it for a very long time because it's fallen. And human psychology being what it is, no one likes to realize a loss. But if something fundamental has changed in a stock that you are following, and the reason that you bought it is now no longer valid, then you absolutely should sell it. The good news about selling at a loss, especially in your main name, is that you can carry that loss forward and offset it against all the gains you'll make later on the other good decisions you make.
Yeah, absolutely.
So how people have made money, and you've already touched on this, and it's staying invested. And as you said, it doesn't necessarily mean staying invested in the same thing. It can be staying invested, just generally. As I said, you should take the profit now and again, but rebalancing is also an important phase of investment. You need to reassess every now and again where you are personally, what your risk profile might be, and whether or not you should have a think about that and change that. And that again is a primary role of a wealth manager and a wealth management system. It's quite hard to do, but I think it's really important if you stay invested, then generally speaking, you will ride out a lot of the bumps that come along, and the long-term total return of the FTSE 100 since 1984 to the end of I think it's 2019. My stats, it's about 7.7%. So it's a pretty good, taking into account all those down years. So if you stick it out, you can generally ride it out. And then, of course, there are two elements to investing. There is the income that your investments produce, as well as the capital gains that they produce. And if you're in a position where you are earning money and you don't need to spend your income, then reinvesting it is a fantastic idea. Compounding up is brilliant. As Albert Einstein did call it compounding, the eighth wonder of the world, by the way. That shouldn't be a question. So if geniuses like him understand it and realize that by having an amount of money and rolling it up, it works out pretty well. I think I did some, the stuff I did was on costs. Yeah, so cost is the other element, as we've just decided. You need to keep your eye on your costs, because sometimes they can creep up a bit, and for every increase on the cost of your investment, there is a problem. I mean, it might be that you have an investment which is very expensive but is giving you fantastic returns. In that instance, it's worth paying it. But I did a bit of a calculation, and if you had £100,000 invested in the market, and it was earning that long-term rate of about 7.7%, and you held it for 20 years, at 1% fee, your total wealth at the end of that 20 years would be £369,000. At 2%, it's £305,000. So you've already lost £63,000 worth of return. If that was 2.5%, if you hadn't really been paying an awful lot of attention, and you held investments which have got a bit expensive, that would be down to £278,000, which would be a total of £91,000 that you've lost, you've given away in fees. You'd be a third better off by being at 1% than 2.5%. And it doesn't sound like a lot, but the impact is huge.
I totally agree. I think this is one of the biggest problems, if I'm honest, with the retail investing market, is because people don't quite understand the impact of the fees, and they just pay away the seemingly benign 2, 3, 5%. There are certain companies in our industry not very transparent with the fees as well. Take entry fee and exit fee, and that technically wipes out most of your return over long term. So I think this is one of the things that there are regulations and rules trying to crack it down. So fee transparency is what we would advise everyone to look at, not just with Rosecut, but with everyone else, and really compare apple to apple. Of course, that's not the only important thing. You need to look at the returns as well, but paying attention to this and not letting it eat away most of your return is super important.
That's right, and as we said previously, investing tactically and making sure you're using the right wrapper and the right allowances is also really important. We all hate paying tax, right? But actually, there are some things that the government, especially here in the UK, has done that should encourage investing. Everybody has an annual capital gains tax allowance of £12,300, and that's this year. And you can transfer assets between spouses free of tax. So if you can use your allowance and use your partner's allowance, then that is great. You can put up to £20,000 a year into an ISA, where all capital gains accumulate free of tax, and you don't pay any additional income tax. And you can put money into your pension. Now, I'm not, as you've already said, the pension rules are pretty tricky, so I'm not going to give anyone any figures as to what they can put in their pension, because it does depend entirely upon their personal circumstances. Mm-hmm. But you can also, use previous year's allowances. If you haven't used your full pension allowance, you can sort of roll it back for up to 3 years. So there are things that people can do on a tactical level, which means that they can make the most of some of their investments.
Yeah, during my time at Coutts, I've actually saw those ISA millionaires, which was quite impressive, because if you think about how little the annual allowance was before, like 8,000, 10,000, 12,000, after 20, 30 years, with the compound return and frequent contribution, they can get up to $1 million worth in the ISA account. And it's actually the same logic for the pension and stuff like that. The whole point is to start working on it and contribute it to it early on, right? Before the majority of your professional career moves on. So I think this is another important thing that Rosecut is trying to do, is to help people as the most impactful years during the earning power and during their professional career. Shall we move on?
Yeah, absolutely. So the don'ts. How to lose it. I mean, this can be taken in many ways. I presume we're talking about money rather than your sort of mental capacity dealing with losses and errors. Yeah, I mean, we're going to come on and talk about inflation in a minute, which is obviously incredibly topical right now, with the cost of living getting so expensive. But it's important to realize, as I think we've already said, that cash is not always king. It's important to have some cash around, obviously, because we all have expenses, we all have things which happen unexpectedly that you need to take care of. So you don't want everything locked up in long-term investments. But holding big amounts of cash is really not a great decision. Because with inflation and low interest rates, as they have been, the real value of your money is getting eroded all the time. Now, equity markets are never a perfect hedge, and every textbook you read will tell you all about it. But with all things being equal, equity earnings and equity performance should at least keep pace with inflation. So, as I said, with all things being equal, things are never equal. There's always a million things going on, but it's important to bear that in mind. We've got here that you shouldn't speculate. I think that's right. If you stick all your money into one stock, that's a pretty risky place to be. Let's talk about not putting all your eggs in one basket, and with investment, that is always true. And it's not just choosing 7 or 8 or 12 different equities. It's putting it in different places in the world, is putting it in different industries and different sectors which have different return profiles, to make sure you really spread your risk and diversify away from that one central position.
Totally. And I think I will probably mention something about the over leverage and concentrated bets.
Yeah.
So what I've seen people doing is they felt pretty proud of building a buy-to-let portfolio. You can start with one, and after some time, the valuation of the property goes up. So you remortgage, takes out as much as equity you can through that and put into another buy-to-let, and over time you can build a portfolio. So, let's say a portfolio of 5 buy-to-lets looks impressive in terms of the gross asset value, and you manage to get a lot of mortgage to fund that, and all of a sudden you have a good income stream on a monthly basis. But the tax rules have changed. Your mortgage payment now can contribute 0 to the tax deduction, so people are paying income tax on the gross amount, and the potentially interest rate could go up, and all of a sudden you have what we call a liquidity squeeze, with this kind of over leverage play. So you have high assets, high liability, very little protection against fluctuation of interest rate or fluctuation of the property price, because if one of the properties drops below the bank valuation, you might get a call to top up, and if you can't top up, then the whole thing collapses. So there has been, in the past 5 years, a lot of people selling their buy-to-let portfolios because they realize that they cannot put up with the whole of the cash draining every month just after the tax change. And that itself is also a concentrated bet of the UK economy or UK real estate market. And with all these other problems of the illiquidity of having real estate investment and stuff like that, you could take 10 years to build up a buy-to-let portfolio, and takes just a year to collapse. And these are not the sustainable ways of wealth creation for the long term. And it may not be the pension pot that you think you are building, very susceptible to changes and external risks. So this is, one of the often things we see in the British culture, and sometimes in Chinese culture as well, of having most of your money, if not all, in real estate. We recently had some clients selling his buy-to-let portfolio, not making money and not putting money into the rose car, as he compared the returns through the past 3 years, not being able to make any money on the real estate side versus the return that we generated for him.
Yeah, absolutely. It's a tricky area. And especially at the moment, you think if you were taking out a loan back in 2019 for 2019 for an investment property, base rates were at 0.1. As of today, they're 1%. That's a 10 times increase, which will, that will seriously affect people's cash flow.
Yeah, daily cash flow, the cash flow of servicing your debt, and in addition to looking after your monthly outgoings is a massive problem.
Absolutely, yeah. So, Georgia,
yes.
How can Roosevelt help?
Here, we're very happy to announce that we have completely revamped our products, and but continue providing the service like what we have been doing for the past 2-3 years. So we are a digital investment platform with real human support. And we provide the private banking level of service as well as investment return with true international setup. So you can have UK tax efficiency account, ISA, SIF, junior ISA as well, together with offshore account in Jersey or Leicester for the international jet setters. We use 3 different custodians: Wealth Kernel, Credit, and LGT, with different account minimums, but mostly for people to for different tax circumstances. And what would set Roosevelt apart is that we are looking to service those who still need to make a living, who have a great chance of making it to financial freedom. We show you a way out and a highly probable way to a life-changing amount of money, so you can be free to do whatever you want after that. And we show you the potential of how much you can have in the future, not just how much you have today. And we hold your hand step by step to show you the most impactful things you could work on one at a time to optimize your finance. And we manage your money for you, so you don't have to stock pick or log into trade. Because of that, now we have relaunched our app with a brand new flow, and to show you the things that you probably have realized before but could not see it, as it could not pinpoint exactly, or we give you, clear guidance in terms of how well you are doing in your overall, financial arrangements, and which are the areas for improvement. So, we would very welcome you to download our new app from iOS and Android App Store and give us feedback and let us know whether you're enjoying that. And lastly, the lifetime cash flow projection here, we have two versions. One is to show you what potentially you could have by the time you retire at 65, or another version is to show you by what time your investment return could cover all your living expenses, so you no longer have to work. Of course, you could choose to work for passion, but it's nice to have an option in life. I think the whole point for Rosecard is to let you focus on the big picture and the long term, rather than getting down the rabbit hole of what stock should I be buying, or count how many lattes I'm having on a daily basis. No, you don't. You just need to focus on making the right income and control your monthly spending and keep building on your investable assets to the point where you have the freedom to choose whatever else you want to do with your life. A lot of our audiences here are highly paid professionals. You have a great degree, you work hard, you manage to save a portion of that, and now you just need to get on a path to where you want to be. And this path is, not less important than your professional career. It's as important, if not more, because what's the whole point of having a great career and great salary but not making use of it to the fully extent and to earn freedom out of it? So we would very much appreciate if people can take a look at our new app and explore what they can see and can learn from that. So, as mentioned, it's available now on Google, and just to correct, on the App Store, on the iOS App Store, we're still under the review, but it will be available anytime soon. So if Nick, we continue going to the final part about our future planning, cash versus investment, and this is where you could handily link it to what's going on in the world. That'd be super helpful.
Yeah, I feel like we've maybe over covered this as we've gone along, but I think it's a drum worth banging. Okay, interest rates have just gone up. They're now 1% in the UK. The Fed doubled the rate overnight from 50 basis points to 1%. The first time since 2009. I think they've gone up by more than a quarter of a percent. So it's clearly serious. Inflation's running at 7%. So even if you are managing to get 1% on your savings, you're still losing 6% real value on your cash. That is a huge amount. So by not making a decision, you're making a really bad decision. And then you compare that, as I've said already, to the long-term capital gains, time-weighted total return of markets, and that's about 7.75% every year since 1984. Now, clearly, as I said, there were bad years and there've been good years, but that's a long-term return. That is beating inflation. So even if you're paying, some tax on that return, you are going to beat inflation, which is, I think, the real key. By sitting in cash, you're going to lose the real value of your money. By investing your money, you are taking a bit of a risk, but there are things you can do to mitigate that. But equally, it's important to make that step. It is a big step, I appreciate it, but Chowder and the team, amongst others, will be able to help you make the right decision.
Amazing, thank you for that. And I would just really come in to add that, you know, there are economic cycles, you know, that's just inevitably how the society and the financial world operates. There are up and downs, you know. Once you take the first step to get into it, after a while, you know, with more knowledge and more experience with it, you will be desensitized and realize that's just part of your life, you know. Financial instruments, stock market, it is a wonderful invention for normal people to have a slice of ownership of the machines, the companies who are generating, you know, productivity and creating GDP for the country. And then with that slice of ownership, you get payout through either dividends or capital gain. And this is basically a tool for us to get out of our hand-to-mouth cycle. And people need to realize that this is to their advantage of learning this to be able to, you know, earn their financial freedom and future. So I think with that, we've quickly covered through the key points today, and we can go into our Q&A section now. We've got 4 questions here, and if other people have more questions, please, you know, feel free to type into the Q&A buttons now while we are answering that. So the first one from someone anonymous, there's often this narrative that women are more risk averse. Can you talk about that? Nick, I'll let you answer it first and I'll add something.
I think you're probably better qualified than me to answer that one, Chowder.
Okay, so I would say it's a very interesting question. We've actually recently done a user testing, you know, with 50-50 split gender. I would just share my observations. First of all, I think women are less interested in financial knowledge by a long yardstick compared to their male counterparties. The male, in general, men are very interested in making money and more financially motivated. So that reflects in the level of knowledge they have. Second is women are less confident with investing. They really need a bit more hand-holding to kickstart, whereas men more likely just to download an app and, you know, just try around with trading and stuff like that. However, once women have gone into investing, they appear to be far more disciplined against speculation, which is typically the biggest problem for men to lose money, because they love the adrenaline rush of up and downs and speculating in different things. Of course, I'm stereotyping, but this is just the general behavior we have observed. And if you look at the stats of, you know, women entrepreneurs versus male entrepreneurs making the same sort of money, you will see a very interesting stats is that many of the men will convert to investors and then sort of go into a different career path after the entrepreneurship, whereas women tend to stick around for that. You will see much less of examples of, you know, for example, maybe not the most obvious one, Ashton, the former actor, turning to a great VC investor and stuff like that. So I would say women are more risk adverse, might be true, but both genders have the sort of different strengths. And UBS, for example, for the past 5 years, have always tried to target, you know, female clients and then bring more sort of education to them. And there is a bit of a sort of gender stereotype of how men used to always look after money. So I would highly encourage, you know, women investors to step forward to really learn and to do this, knowing that they have a natural advantage once they have started the game. The second question, should I, from a client actually, should I allocate money in cryptocurrency and NFT? What's your view, Nick?
If I wasn't qualified to answer the last question, I'm absolutely not qualified to answer this one.
Okay.
I'm I am involved in the cryptocurrency business, but that's very much as a sort of strategic advisor rather than understanding all the pipes underneath it. I think that it's a really interesting area. I think that there are lots and lots of positives about decentralized finance. I'm not entirely sure that cryptocurrency is the right investment. And as for NFTs, I've no idea.
I think that's a very candid answer, Nick. I would say, first of all, depends on what kind of investor you are. First of all, some type of investors just say, give me return. I don't care what you do with my money. And, I just want the convenience of someone else looking after my money and rely on the expertise to do it. I just want to live my life and take away this problem from me. Yeah, in that case, why would you go through the hassle of taking money into crypto or NFT? Because your dedicated money manager is supposed to make that decision for you. And there's a second type of investors in general is that they would really enjoy sort of try their own hands, try with their own hands and make returns from it. Maybe sometimes not the best possible return, but a bit of learning, and they grow that way. Yeah. So if you're the second type, I would say allocate some money into it, and the amount of money should be, in general, no more than 5% of your investable assets at maximum. And it's an amount that you're completely comfortable of losing tomorrow. Yeah, if the whole thing flops, you are okay and it doesn't impact your life whatsoever. So again, to reiterate rose-cut view on cryptos, we are very interested in this area. We are looking at it on a regular basis. We think this is something substantial in the future. But as of today, the infrastructure in the financial services world does not meet our standard of safeguarding that for our clients' money. What I mean by that is that you might have some return in cryptocurrencies, but you cannot be sure that you are not going to experience theft of that money, and then what's the point of the return? Yeah, so there's technology, obviously a lot of money is throwing into this, and there will probably be a point where we make up our mind to say, okay, that's good enough for us. We feel comfortable of allocating a small slice of our clients' money into that. By that time, we'll talk about it. Our portfolio manager, Daniel, probably will share more in depth at that moment. But as of today, we do not allocate our client money to cryptocurrency. The third question from someone anonymous: given risk isn't taught, why are people left to decide their risk tolerance?
Yeah, and this is a sort of ongoing battle that we had at SmartWealth all the time, and we took the decision that people shouldn't be allowed to decide their risk tolerance. We had a behavioral finance tool as well as a financial algorithm which worked out how much money you could comfortably lose, and then we tested as to whether or not you were the kind of person who would be able to bear that loss mentally. And if people were coming out at the lower end of it, we wouldn't let them invest in high risk strategies, because that was advice. We were giving people financial advice, and I think that's the real key here. Are you getting advice? Are you getting guidance, or are you being left alone? Basically, there are lots of people out there on trading platforms, as Chao just says, who have been able to decide that they want to take big risks with their investments. And who knows what will happen when the market shakeout comes along and they lose a load of money. Equally, a lot of people in that sort of guidance bracket who think they've been given advice, they may find at the end of the day that they weren't given advice. It was just guidance, and essentially their investment decision is on them. And I think this is a real problem that the industry. Yeah.
I totally agree, Nick. I think this is where, I would again use the medical industry as an analogy. You have the over-the-counter medicines that you can buy without medical advice, or there are certain strains, about certain strains, you need a prescription to access. And financial market should exactly operate in a similar way, given how internationally competitive and how complex it is. Whereas right now, some of the sort of technology innovations make it possible for you to buy, highly destructive, potentially highly destructive instruments over the counter. And with Rosecard, we don't allow you to decide your risk tolerance either. We get you to go through a risk assessment process where we decide what is the best for you, just like a doctor deciding what is the best, treatment plan you should be getting on. Of course, if you want to have a conversation, if you disagree, we can have a discussion about that, but it should not be user-led or user-driven in this sense. The next two questions are both about our Jersey tax advantage or offshore investment accounts and allows tax savings and stuff like that. Okay, so this is, let me explain that. So Rosecard is built for international citizens. We do not say, okay, we just want to work with UK people, because we have a strong view that London is built by a lot of immigrants, first generation, second generation. They come here with their brain and with their money. Yeah, so for those people, the UK tax regime is very complex to navigate through, and they do not necessarily feel like they are committing the rest of their life to this country either. There are international mobile people, means they move country every 3-5 years, or there are international fluid people who basically were in the US last year, in UK this year, and heading towards Portugal next year. And you see a lot of those people in tech as well. So when you have this kind of lifestyle, it's a complete mess to deal with different countries' tax rules and jurisdiction rules and stuff like that. So what makes sense is for you to have a go-to offshore account to park all your spare cash, and then create return for you, tax-free and completely, legitimately tax-free, while you earn income in a specific country and pay income tax in a specific country. So in other words, you take your after-tax income of the tax resident country and put into your offshore account. This is not for everyone, for example, not for British domicile people, but for international audience that Rosecard cater to. So, in fact, majority of our clients are of that background. So for this kind of investment accounts, there are different criteria depending on your passport and your tax residency and stuff like that. Please feel free to reach out to us after this. You can either, drop us a chat on our website or email contact@rosecard.com, and then we can talk to you more about that based on your personal circumstances. But in general, it's a wonderful sort of efficient tool for people to manage their finances while they move countries. The next one here, I am any advice of people who are stuck with a tax death valley, 60% tax bracket between 100,000 and 125,000, and what advice do you have for people in this group to reduce their effective tax rate? Very good question, and I imagine a lot of the audience here are in that bracket, especially here from LBS. First of all, we do not provide tax advice, we provide tax guidance. So this is not catered to you, but in general. We covered on how you should contribute to your pension. So that's one way of getting some tax claim back from that 60%. And so second thing is that you can do other sort of tax efficient investments, such as investing to highly risky, illiquid startups. Again, do not put all your money into that, but if you want to try that, there's SEIS and EIS investment opportunities through crowdfunding platforms or through angel syndicate, whatever there are. And the third thing is that when you are looking at this, you can plan on a family level to see, you know, if your partner does not fully utilize the tax allowance. So for example, you know, there's marriage allowance if your partner is not working, staying at home, or if there are, you know, other things that other tax rules like ISA and pension your partner does not fully utilize. So tax planning usually becomes very efficient when you look at the family level and utilizing, you know, both sides of tax allowances. And we work with very good tax planners on this. So if you want to dig into this topic, feel free to get in touch with that as well. So the next one is really interesting. I'm not a super rich person, but I like Rosecard and would want to engage with your services. Can a normal person like me can opt for your support? So I think let me repeat this again and loud and clear. You know, Nick and I used to work for the super rich in the banks, yeah, but we both left that job and want to do something more useful and more impactful. So Rosecard is not for the super rich. Super rich requires a different infrastructure, to be honest. So what Rosecard is trying to do is to bring the knowledge that helps the super rich to stay rich and make it, you know, more accessible for normal people. So, you know, we provide our planning completely for free for people. So you would, you know, typically pay thousands of pounds to an IFA to access the kind of things we give it to you for free. You just need to download the app. If you like what you can see from the app and want to invest with us, then there are friendly, you know, initial amounts. So we need £50,000 as a minimum commitment. Or, you know, if you want to commit a couple of years, ISAs, £20 or things like that, and a long-term payment plan, we could do that to help you to build up a 50K, because we think that's the beginning of a, you know, life-changing amount of money. So someone asked about Rosecard was considering equity crowdfunding for investors in the UK last year. Was there some change of plans? Are you considering any in the near future? Very good question. Thank you for following us for a while. So yes, last year we were going to do equity crowdfunding, but what happened is that we closed the funding round last year where we were oversubscribed. So literally there was no space left for equity crowdfunding. How we see equity crowdfunding is that we think it's a great way to engage with our audiences and, you know, to be able to really, you know, build a community from that. So there is still, you know, plans to do it in the future, but the cons of doing that is that it's a very labor-intensive process, to be completely honest. It's far more work than taking, you know, a few checks from professional investors. If I'm honest. So given how small a team we are, we have to prioritize our resources for the, you know, best result of the business. So we will probably do that when we have the right resources to do so. Next question, I see Rosecard does active portfolio management. Can you give an example? For instance, you've mentioned you shouldn't necessarily sell when the market drops. What has Rosecard done this past months with equity portfolios or holdings that has dropped a lot in value, sold, bought, held? How do you make those choices? Great question. So, you know, if we are talking about our active portfolio management, there are a couple of things. So what do we mean by active portfolio management? To start with, what's the difference between, say, you buy a single ETF of that tracks the global equity market? So active portfolio management means that we actively make decisions to go away from the default allocation of the global you know, equity market. For example, UK constitutes as 8% of the global equity market. If we are feeling optimistic about UK stock market, we may put 10%, 20% of our total portfolio into that. If we are thinking UK might underperform the rest of the market, we will put 3%, 5% into that. either way will be higher or lower than the average 8%. 8% means you do nothing, you just track the market. Yeah. So we actively make these decisions on our portfolios based on our in-house research and experience, and whether we are right or wrong can be actually measured black and white. And one thing we don't actively sell, Roosevelt for, is that we have been consistently beating the benchmark for the past 3 years. The benchmark is the average return of the private banking industry and wealth management industry in the UK, and we beat it by a wide mark, 3%, 5%, that kind of thing. So, whether we have made the right decision to say, put more money into UK is evident. And for the past months, where there's a lot of volatility in the market due to the war and inflation and things like that, I can tell you that we went into that phase holding more cash than average investors. Because when we think the market is not going to perform so well, we would prepare to have more cash to go in at a better time. So, you could call that, having a bit of strategic tactical play at times to create additional return. And this is how we deliver the return in the past. All this is based on decades of experience of the investment committee, who are made of, former Barclays private bank portfolio manager and the former global chief investment officer of Credit Suisse. And myself, but I'm just usually there to contribute client feedback and things like that. So all this, means active portfolio management to deliver extra return. But even if we can't promise the additional return, because no one can, one benefit of active portfolio management, if it works, is that it helps to give you downside protection. Example would be in 2020, when the market crashed 35%, 40%, both in UK and US, our portfolio was down 13%, 1-3. So 1-3 is much easier to swallow than 35%. And then this is where it makes a difference when people are in discomfort zone or panic zone where they have to sell and then get burned and stay away from the market for the next decade and, completely lose out through that process. So, active portfolio management also means, you get a bit of comfort knowing someone is looking after your money and making decisions for you, and the numbers tend to look less volatile during the worst crisis times. I hope that explains, but if you want to know more of that, we can organize a call between you and the portfolio manager. So another one, can you please define investable assets when you refer to a percentage of investable assets? Is this just the cash you have at the moment or something more nuanced? Good question. We explained that on our platform really well. So investable assets is something that creates return for you. So for example, if you have bought your home and you put down, 100K into it as equity, that's not your investable assets, because your home does not generate capital gain for you unless you sell it, or it doesn't generate rental income for you because you live in it. So investable assets are the things that it has been invested. So it could be cash that you can deploy. It could be your ISA or pension pot that you have somewhere else, or it could be your buy-to-let property. That's all your investable assets that generate a return for you, whether they are optimized or whether that's a right allocation between, illiquid versus liquid stuff. That's next level we look at. Final question. How do you define super rich? Actually, there is a textbook definition in our industry. Super rich is someone, there's a few versions. Banks usually think someone who has 50 to 100 million investable assets, pounds, as super rich. And I would say half of my clients are, billionaires back in the banking days. And another more philosophical definition is if you are self-insured, that you no longer have to work for money, and all your needs are covered in terms of asset size, and you are a super rich. But I think that's 1 out of a million, and frankly, I think that's the sort of key target audience of the private banks, and that's the world I decided to leave behind. So Rosecard is not catered to the super rich, but there are more natural habitats for those guys where they need and they demand white glove services. So that there's that. I think that's the end of the questions, and I really appreciate you guys spending the time, spend the past hour with Rosecard, and thank you, Nick. Thank you again for taking the time to talk to our audiences.
My pleasure. Thank you very much.
Bye, guys. See you guys next time.
Bye-bye.
Bye.